This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to share with you a stock that I recently bought on the ASX. Now I'll be sharing with you this stock using a Peter Lynch approach to investing. So I'll be sharing with you his philosophy on investing and explaining how this stock fits his philosophy of investing. So if you enjoyed today's video, be sure to hit like and subscribe, but with no time wasted, let's get right into the video. So firstly, I wanted to talk about how Peter Lynch actually invests, and he summarizes his investing into three things that he looks out for. The first one is that he should only buy things that he understands. Secondly, he wants to buy stocks at a reasonable price depending on how much growth is available. So the acronym over here is GARP, and that stands for growth at a reasonable price. And lastly, Peter Lynch is looking to invest for the long run. So he's not investing just for the next 6 or 12 months, but rather he's investing for the next 10 years. So it's very important to understand what you're buying in order to understand whether the price that you're paying is reasonable and whether the company will still be around in the long run. So let's go over the first thing over here, and that's to understand what we're buying. So the stock for today that I'll be talking about is Collins Foods Limited, stock ticker CKF ASX. Now this is a company that has a market cap of 1.26 billion, and they also do pay a dividend of 2% roughly, and it's trading at $10.82 as of Friday closing. All right, so this company operates the KFC restaurants in Australia as well as Germany and the Netherlands, and they also operate a few Taco Bell restaurants in Australia, and they are also the lead franchisor of Sizzler restaurants in Japan and Thailand. Now they categorize their operations into three different categories. First one is KFC Australia, and in KFC Australia there's 252 restaurants, and that generates them a revenue of $900 million. Over the past year, there was same-store sales growth of 12.9%, and they generated an EBITDA margin of 22.2%. So this increase in same-store sales growth has been quite phenomenal, especially during the COVID period. And the reason that they've been able to do so well is that management have continued to execute well, and there's a high trust in the KFC brand. During times of uncertainty, Australians flocked towards KFC. During the year as well, there was huge growth in its e-commerce sales, and e-commerce sales makes up roughly 14% of KFC Australia's total sales. So KFC has done really well in Australia. However, the same can't be said about KFC Europe, because the COVID situation over there was slightly different from Australia. The lockdowns were more significant in Europe, and there were basically curfews as well as complete shutdowns of certain restaurants in Europe. So that had caused same-store sales to decline by 0.6%. KFC Europe has 46 restaurants, 17 in Germany and 29 in the Netherlands. That generates them $134.9 million in revenue, and they have an EBITDA margin of 7.3%. And lastly, they also have Taco Bell restaurants. This is a relatively new division that started in 2018. Currently, there's only 16 restaurants generating a revenue base of 28 million, and over the past year there's a 3.9% increase in same-store sales growth. Taco Bell currently is operating an EBITDA margin of roughly break even, and this is still a relatively small division, as you can see, 28 million across a total group of over $1 billion. So this is less than 3% of total revenue. So for this video, I'll just be mainly talking about KFC Australia, KFC Europe in general, as this makes up most of the business. All right. So in terms of how well a fast food restaurant does, it really does depend on three things, that is price, convenience, as well as taste. In terms of its costs, KFC sells chicken. They have staff costs involved. People need to cook the chicken and sell the chicken. And there's also royalties that Collins has to pay to Yum Brands in the US, because KFC is owned by Yum Brands, the brand itself, and Collins is operating the KFC stores. So they have to pay some kind of royalty for using that KFC brand back to the US, all right? Now I'm gonna digress a little bit and share with you a discussion that I had with a friend who works at Papa Rich. In case you don't know, Papa Rich is a Malaysian restaurant, And there's restaurants in Australia as well as New Zealand. The reason why I want to share with you this discussion is because I thought it shared decent insights on the restaurant industry in general. Maybe this might help you, maybe you already know this, but I'm going to share it anyway. So I asked my friend if they would invest in a business like Papa Rich or whether they would invest in a business like KFC. And my friend told me that they would rather invest in KFC because Papa Rich is a very difficult business, and that is very similar to other restaurants out there. I'm not saying Papa Rich is a bad business. I'm saying this is very similar across other businesses that are not fast food. And the reason can be summarized over here. So in terms of running a Asian restaurant like Papa Rich, you need skilled staff that can use a wok properly and have good wok skills, right? To wok, to cook the Asian food, to make it taste good. And to find these type of people that have those wok skills is very difficult during lockdowns and during pandemics where no one's flying in and out, especially from foreign countries. So that is very hard to find, skilled labor. Whereas with KFC, you don't really need much skill involved to fry the chicken, to be a kitchen hand at a KFC restaurant. Secondly, the materials is harder to source for certain types of foods out there, especially if it's foreign. You might have to import these from foreign countries, whereas with KFC, chicken is readily available anywhere. And as we can see over here, the long-term pricing of chicken has not really gone anywhere over the past 20 years. So this is the Australian retail prices of meat. However, I do suspect the wholesale pricing, which is the pricing that Collins will be able to buy that for, will follow retail prices very closely as well. And you can see the demand for chicken meat consumption has been increasing over the past 50 years, and that is basically a function of the availability of chicken meat because it's so cheap, and there's advances to technology that has reduced the cost of producing chicken meat, right? So that is the most consumed meat in today's society. So that is understanding the business. Now let's take a look at growth at a reasonable price, understanding the valuation of the business. So we're paying a price today for the company's future growth. So we need to understand what growth prospects are there for a business like Collins. In terms of Australia, there's a lot of things that the management team have already told us. First of all, they have already mentioned that there's going to be store development in the next year of 9 to 12, as well as a minimum of 55 stores by FY28. Now, another area of growth is through delivery and digitization. So e-commerce makes up 14% of KFC Australia sales. In addition to that, they're going to invest hugely in digital menu board installations, and that should cover all restaurants within the next 3 years. So that would lower the employee costs, as they might not need as many people on the tills taking the orders. People can just go to the kiosks and order their food there. So that will drive down employee costs, expanding their profit margins. In terms of KFC Europe, they plan for store development of 2 to 4 by FY22, and they've also developed a strategy to acquire underperforming stores in Europe. And over the next year, KFC Europe should do well as Rona restrictions ease, and the management team is aiming for a doubling of business by 2026. So that is a huge statement over here and does bode well for the future growth of the business. And lastly, we also have Taco Bell. Taco Bell, they plan to develop 9 to 12 in the next year. The growth of this business, or the success of this business, really does depend on the increased consumer adoption of Mexican category products. So this is a relatively new division. So that's something to watch out for, and I see this more as of an optionality for Collins stock at the moment. So now I'll share with you my intrinsic value calculation for this business. So over here I have the historical performance of the group as well as its other divisions over the past 5 years. And I've basically forecasted the next year based on what management has already told us in terms of the store growth. And as you can see over here, I do project stores to increase by 7.67% over the next year. And that closely aligns with the previous 5-year compounded annual growth rate. Revenue should grow at a similar rate as it has over the past 5 years. EBITDA following on as well, up 11%. And I forecast net profit to be roughly 60 million over the next year, which aligns with its previous 5 years. Now, in terms of its intrinsic value, I've used the free cash flow of the most current year, and I project a growth rate of 11%, which aligns with the revenue growth of the business. And over the next 4 to 6 years, I've reduced that growth rate by 2% to 9%, and then another 1% at 8% between years 7 to years 10. I give it a terminal multiple of 25, which is slightly higher than its current earnings multiple, assuming that the business continued to generate solid growth and deserves an appreciation of its valuation by the market, and that gives me an equity value per share of $11.27. So that represents 4% upside. So with no margin of safety, this stock looks like it's valued pretty fairly at current prices. Now over here I have the Ticker website, and Ticker is a very useful tool to look at valuations of the business and other things out there. So if you are interested in using this platform, I have a referral link down below. But basically this is Collins' valuation multiple over the past 3 years. As you can see, it's trading at a normalized next 12 months price to earnings of 22.27 times. Now I also have here Domino's Pizza's price to earnings ratio. As you can see, Domino's have a much higher PE multiple, however they do have much higher growth. It's not really useful sometimes to compare comparables with other companies because there's different growth prospects. Looking at current earnings, I think it's fairly valued at 22 times. There's always potential downside. It's come off a little bit, and I think its current growth rate accurately reflects the current earnings multiple it's trading at. And as you can see over here, they've been reducing their debt over the past 2 years. They have a net leverage ratio of 1.33 times, and their current covenant ratio is 2.75 times. So basically they can double their net debt and still be within their covenant. And that does show that the group has sufficient debt facilities to support future growth initiatives ahead. Now, if we come back to Peter Lynch and his 3 points of investing, the last thing is that we should invest for the long term. The first thing that you need to ask yourself is whether KFC will still be around in the next 10 years. There's a risk of a trend towards healthier food, obviously, but how I like to see it is that healthy eating has been around since the 1980s, and KFC is still around today. So I definitely think KFC will still be around in the next 10 years unless there's some sort of disease that kills off all the chickens around. I see that as very unlikely. Secondly, this stock is a defensive and a growth stock at the same time, which means that it should still be around over the long term. In the short term, with COVID restrictions going on, its defensive nature is that people still eat KFC. People love it in Australia. However, if COVID goes away, then Europe KFC should pick back up as well. And with regards with future growth, we've mentioned before, they're going to have increasing stores with same-store sales growth, as well as the optionality with Taco Bell. And lastly, we take a look at management team track record. Over the past 5 years, they've done tremendously well, as discussed before with the numbers, but over here is a more visual representation of the performance of the business. I think this company has been executing well and should execute well going forward. This is not a difficult business to understand. This is a very easy business, and easy business sometimes are good investments because it is very predictable. And I think going forward, the company should generate investment returns of roughly 10%, very close to its underlying profit growth. Because currently its valuation in terms of price to earnings multiple is not low. It's certainly not cheap, but it is at fair value. So most of the growth will definitely come from earnings growth. The share price could take a dip if earnings multiples contract. So if it trades at a lower valuation, that is when you could potentially lose money. But stocks like these, good quality stocks, usually don't come at a discount. So it's very difficult to buy it at a margin of safety, which is why you need to take a longer term approach and think about over the long term, how much returns can I generate with this investment? And it usually is very closely aligned to its earnings growth over the long term. So that's how I'm seeing it, and that's why I have initiated a position in my private as well as in my public sharesies portfolio. So you'll see that stock in my next portfolio update at the end of this month. So let me know in the comment section down below what you think about Collins. Always keen to hear your thoughts, whether you eat the chicken in Australia. Let me know how it tastes like, good or bad. Leave it in the comment section down below. But thank you guys for watching. Hope you enjoyed today's video. Until next time, take care.